Investment markets have been strong recently, with equity markets up between 10 and 15% year to date, most of these gains generated since the middle of June. Eurozone bond markets are also up over 10% this year. The principal reason for these moves has been the support and monetary stimulus provided by global central banks. As Eurozone debt crisis escalated, the ECB responded by announcing an unlimited bond buying programme called Outright Monetary Transactions, or OMT, under which the ECB will buy sovereign bonds out to a maturity of 3 years, lowering yields to levels where peripheral countries will continue to have access to funding markets. The response to the intervention has been positive, with Spanish and Italian yields falling sharply, particularly at the short end. The move has also significantly reduced the tail risks of a euro breakup and a severe economic downturn across Europe and the world. The reduction in downside risks has enabled European equity markets to become more investable again and has facilitated their recent recovery. In bonds, core markets such as Germany had benefited from a flight to safety as investors sought capital preservation. Now yields have begun to reverse across Europe as German yields have risen, with peripheral yields falling. This pattern should continue over the medium term if policy initiatives prove successful in addressing the problems. In the US, there has been a recent improvement in economic releases. Despite this, growth remains below the norm pre the financial crisis, and unemployment has remained sticky at around 8%. As a result, the Fed launched its third quantitative easing programme, QE3, to stimulate growth and reduce unemployment. $40 billion of mortgage-backed securities will be bought each month and is different to previous measures in that it has no set end date. The Fed has stated that the pace, size and composition of asset purchases will be altered as required to meet its objectives. The Fed is indicating support will be provided until the economy is on a firmer growth track. Since the onset of the financial crisis, equity markets have tended to rise while various QE programs are being implemented and have drifted when they have ended. Other central banks have also increased their stimulus programs over recent months, such as the Bank of Japan and the Bank of England, and additional measures from these and others are likely in coming months. While markets have improved, risks remain. Spain has been slow to request assistance and activate the OMT, given concerns over the fiscal conditions that would be imposed, although it is expected to do so in coming weeks. Greece and the Troika have still to agree the implementation of austerity measures, but recent comments from the IMF and Germany have been more conciliatory, indicating a compromise is likely. There is uncertainty over the level of economic slowdown in China. Stimulus measures are expected, particularly given the upcoming change in the political guard, which should improve the growth outlook. The US faces a fiscal cliff at year-end, where a number of tax breaks are due to expire, which could take up to 4% off GDP in 2013. A compromise is expected where the negative impact could be somewhere in the region of only 1%. Overall, we expect equity markets to maintain an upward bias given the support measures in place and attractive valuation levels which are below historic averages. While economic growth rates will remain modest, there are signs of improvement in the US and tentative signs of stabilisation elsewhere. In bond markets, Eurozone peripheral yields could continue to fall, particularly at the short end, while yields in core markets can continue to move higher. Thank you for listening.